we got a lot to cover today. So, but I do have to say, before we dive into this 122 years of data with Laurence, I just want to let you know who DMI is. So just briefly, we're reshaping what it means to be an independent marketing organization. So we take complex challenges and simplify them, providing financial professionals with powerful tools, expert guidance, and hands-on support to thrive in a competitive market. So with personalized service, experienced in-house marketing, and quick adaptation to industry changes, we're always here to help you turn insights into actionable strategies. So today we've got a lot of insights for you. So why are we here today? It's our main speaker, Laurence Black, and thanks to 𝗪𝗁 Anderson that's here from Athene. 𝗪𝗁 Anderson is a great friend of ours, a senior relationship manager for Athene. We really appreciate him being here as well. But Laurence Black is obviously a renowned figure in the financial services space. And as the founder of the Index Standard and an index advisor to Nobel laureate Robert J. Shiller, Laurence brings decades of expertise in index design and market analysis. His groundbreaking insights into FIA performance are reshaping how advisors view annuities, making today's discussion a must-attend session. So we're really glad you're here. But during our webinar, Laurence, he's going to explore the evolution and performance of FIAs versus bonds over more than a century, the key trends and surprising insights behind what we're calling the 122-year data shock, and then how these historical insights can reshape retirement income strategies and enhance client outcomes. Per usual, as we dive into these topics, consider how this in-depth analysis can elevate your conversations and differentiate your practice and drive better results for your clients. But also take advantage of the Q&A session. Or I'm sorry, not the Q&A session, but the chat session, or actually Q&A. Let's use Q&A to engage with Laurence directly, because we will answer questions at the end of the webinar. So I do want to turn things over to 𝗪𝗁 Anderson for a few words, but then also our very own Tyrell Jensen, who is also going to bring a lot to this conversation with over 20 years of experience of helping with insights like we're discussing today. So 𝗪𝗁, if you don't mind, once again, just thank you so much for helping us to bring Laurence on today. But maybe a few words from you on the topic and our relationship with DMI.
Well, terrific. Thanks for having me here. And DMI is one of the primary reasons we've had our tremendous growth over the last 10 years. If you look at this industry and you look, 10, 12, 15 years ago, Athene was nobody. In the last couple of years, we've been one of the number one carriers in the annuity space. And that's because of our partnership with DMI and just being able to work with a partner that knows how to grow their business and help advisors help their clients is really, really, really pertinent to this. And if you look at risk control indices, they've really been the primary driver of our product innovation. And we've gone to that for a couple of reasons. Number one, with the risk control indice, the cost of that option every year is a much tighter one versus one that doesn't have risk control. And because those costs are a little bit tighter, we can make sure that we can have better renewal rates for our consumers. Better renewal rates turn into what? Products that perform. And if you put those three pieces together, what do? You get a very happy client that wants to come back and buy more products from you, and it makes you, as the advisor, a superstar. So we've been working with Laurence for a number of years, back when he worked with Shiller, and also with the Index Standard. We're really happy that he's on this webinar. Nobody can put this before you better than Laurence. So looking forward to seeing what he has to say today.
Thanks, 𝗪𝗁. And Tyrell, I don't know if you want to maybe say a couple words before we jump over to Laurence. Sorry, Laurence.
No
Yeah, I'd just say a real quick, if there are any questions that come up that you have as Laurence presents the information he's going to talk about, or you have questions around Athene or anything, or working with DMI, reach out to your VP. If you don't have one, feel free to reach out to me. You can always, my QR code, you can snap that and get my contact information. So feel free to reach out. Appreciate everybody, hopping on, taking some time. Laurence is an awesome resource to be able to listen to and gain a lot of insight and information. So don't want to take any more of his time, so we'll turn it over to Laurence. Thank you.
Thank you very much. And I love your QR code. The first time I've seen that. That's pretty cool. So as Glenn said, my name is Laurence Black, and just to give you a sense of why I sort of have an understanding of these indices, I've spent 20 years in investment banking. Started my career as a bond trader, and then I ended up doing index design. So I spent a lot of time looking at these indices, designing them, and then at the Index Standard, and I founded the Index Standard about 5 years ago. And the Index Standard, we're an independent company, a little bit like Morningstar. We rate and evaluate all these indices. We analyze all the crediting strategies and the payoffs. So what I'm going to share today is a couple things. I'm going to break this presentation into three. Firstly, I'm going to go through indices, kind of just set some ground rules, how they work, give you some insights as to what's happening in the index market. And within that, I'm also going to explain risk control. But the good news is I'm not going to bring in any math. I'm just going to show pictures. So it'll all be at a very intuitive level. Second section, I'm going to go through some diversification points. And then finally, I'm going to show you, as I love the way what Glenn termed 122-year shock of some data. How do FIAs compare to bonds, and how does the risk control feature really compare to the S&P? So let's get to it. So the first thing I want to sort of say, just with regard to indices, is that they're all systematic and rules-based. There is no portfolio manager. So the way an index works is the following. You really have a set of index rules, which you can think about as really being like a recipe. And with that recipe, what you're doing, you're looking to do three key things. One is you want to select some assets. Two, you want to give them a weight, and then you kind of want to rebalance that periodically. So an index it's just a rules-based like a recipe. That's the key thing to remember. No portfolio managers. Now, what's the size of the overall market? So custom indices are actually, there's a 1.5 trillion market, and I'm excluding ETFs and all other regular benchmark, just these custom risk control indices or custom indices. It's a very big market. So where does that money come from? Where's that 1.5 trillion? So firstly, we think about almost 800 billion comes from the insurance market. Now, most of that, probably about 400 odd, is from the US insurance market. We think the FIA market is about 700 to 800 billion. But of that, we think only about sort of 45% of that flow goes to risk control indices. Then you also have some money in IULs and in RILAs as well. So that's the US piece. And then actually in Germany and Switzerland, they're very big markets. I was just in Germany earlier this year, and I was speaking to some people there, and they said there's about half a trillion invested in insurance products that are linked to indices. So that's a big portion of that. And then you have Switzerland. Switzerland, again, has a very vibrant insurance market linked to these indices. And then in Asia, a couple things are happening. So in Japan, the FIA market is just getting started. They're also using risk control indices, and that's about 25 billion. And then you have Hong Kong and Singapore are also starting to use them as well. So it's getting pretty big. So we think there's almost 800 billion there. And then with the banks selling structured products, we think there's another 200 to 300 billion. Now, overall, the structured product market is about, it's hard to get the exact number, but we think it's between around about 3 trillion, and about 5 to 10% of that is linked to QIS indices. They're a fairly small part. So we think that encompasses about 200 to 300 billion. And then finally, banks selling these indices directly to pension funds to asset managers and hedge funds, it's about 660 billion. Now that 660 billion comes from a story in Bloomberg that there's a company called Allborn who are pension fund advisors, and that's a number that they put on the market. I've heard that some people think the market is bigger because there's lots of leverage in that particular bank direct channel. But overall, you could say there's about a $1.5 trillion market. So my point here is anytime you have a lot of people involved in a big market, you have very smart people involved. You have a lot of banks that they're designing systems. They're hiring PhDs. So are the asset managers. So this has become a very vibrant place, innovative place in the index market. And I actually say this is where the forefront of innovation is, because you're seeing some of the most interesting techniques out there. So who are the firms involved? So at the top, you can see it's really the traditional indexing houses. So you'll see MSCI, S&P, NASDAQ, and FTSE Russell. And then sort of just below that in the middle, in the majority, we've got a bunch of investment banks. So you can see all the big banks are present, anywhere from JP Morgan, UBS, Goldman, Morgan Stanley, and so on. And then at the very bottom, we've got the asset managers. You've got people like BlackRock, Fidelity, and PIMCO all creating indices. Now, there's one key point I want to sort of mention here. And if you remember one thing from this presentation, this is one of the things worth remembering. When you see an index from an asset manager, let's say it's BlackRock, it's an index. There is no portfolio manager involved. Despite the fact that you might think it's from BlackRock or Fidelity, where if it says index, it means it's a rules-based process and there is no portfolio manager. Now, what are some of the techniques we're seeing? So, say almost 2 decades ago, it was really all about the S&P. Then what we've seen is some evolutions where we've seen more and more sort of complexity being added because, the carriers want to be seen as being innovative. So in the early 2010s, we saw the risk control technique being introduced. And I'm going to kind of speak a little bit more about that later. Then we've seen mean variance optimization being used. It's just a complicated way of saying, give me the best allocation to keep my risk low. That's being used extensively. Then we see some of the banks are using prop signals. They might use a risk indicator to help them decide to go long equities if it seems safe, or to move into bonds if the world seems more volatile. Then we've seen the use of artificial intelligence and intraday risk control. And we've even seen some indices go long short. Now, it's a pretty complicated thing to go short. That's normally the purview of institutional investors. So what I say is, in a way, insurance has democratized the finance industry because some of these techniques, for example, risk control, mean variance optimization, or long shorts, that's really been used by sophisticated institutional investors. But now we can bring those to our clients. So that's a powerful thing. And more recently, we've seen some simpler indices being launched, and they're using intraday risk control feature. And again, I'm going to touch on that a little bit. So we've kind of moved from this extreme complexity where now we're kind of going back to basics a little bit, and we're seeing some intraday indices being used and that are linked to benchmark indices like the S&P and NASDAQ. So as I begin to sort of come into the section where I talk about risk control indices, I want to ask you all the question, and Maureen, perhaps we should have made this a poll, but so I'm assuming that many of you have been on holiday and many of you have flown. So I want you to think about your next flight. Would you rather take your flight on the Kitty Hawk or a modern day Boeing or any other airline that's modern? So the Kitty Hawk was actually invented in 1903, right? Now, I know for me, I'd pretty much take the modern plane rather than going on the Kitty Hawk. So, but that begs the question, why are we still using technology from 1896? The Dow Jones Industrial Average is almost 130 years old, and it's still being used. S&P came into being in the early 50s. NASDAQ came into being in the 80s. So think about your iPhone. We're not using iPhones from then. We're not using airplanes from those times. Things have evolved. So the risk control technique is like a modern approach to indices. Whereas if you look at the Dow Jones, that was invented in 1896, and it's not really always fit for purpose in an annuity. So let me talk to you about risk control and how it works. So the first thing about the risk control technique to remember is when volatility rises, risky asset prices typically fall. Let me repeat that because that's a core concept. When volatility goes up, normally you see equity prices go down. And we kind of remember that. You think about what was happening in 2020 and COVID or 2007, volatility was sky high and equity markets were crashing. So that's the key principle that risk control uses to kind of provide a more smooth and cushioned approach. So now I want to show you the VIX. So the VIX on screen is in purple, and then the S&P 500 is in the light blue. So what you can see is whenever the VIX spikes, the S&P tends to fall. I think I'm in the middle of your screen is a good example. Some of you may remember 2007, the great financial crisis, when banks leveraged up too much. The VIX spiked, and you can see the S&P went down. In fact, it went down about 54%. Now, here's the key thing. Now, volatility just doesn't go from sort of, let's say, 20 up to 80. It kind of gradually tends to rise. So you look where my cursor is, in 2006, 7, it had begun to rise. So this is how a volatility control index works. It senses the volatility. It measures volatility rising. And when it sees the volatility rising, it begins to actually put money into cash. So that's what the key thing, what it does. So this is simply how the vol control works. I don't need to explain this with you using any math. I'm just going to use simple pictures. So when markets are calm and volatility is low, money goes into the risky asset. That might be the S&P or a basket of ETFs. However, if volatility rises and the VIX spikes, then the index will put some money into cash. And it'll do this on a kind of every day. It'll toggle between cash and risky assets. And it'll just sort of move that along. In stressful markets, it'll put more money into cash. And in calm markets, it'll put more money into risky assets. So that's the key thing to remember. You don't need any complicated math. That's the core principle that you need to be aware of. Now, volatility control indices, when they're looking at volatility, typically they've measured volatility over the past 20 or 40 days. That's how they've been designed for the last couple of years, but we've seen some changes. And again, I'm going to come on to that as well. Now, it's worth showing you the vol control performance. Here is the volatility control. It's in the light blue, and I'm showing you the S&P in dark blue. Now, what you can see is a couple observations. Firstly, the volatility control index, it's smoothed and cushioned, right? It's much more stable. And then secondly, where you see those purple arrows, it avoids the drawdowns. The drawdown is a drop. And you can see in S&P in 2020, COVID, where my cursor is, it fell 34%, right? You can see the risk control index fell by much less. So it kind of helps you sleep better at night because it's much more stable. So that's really the risk control index in action. Now, I want to talk to you about some new trends that we've seen in risk control indices that are worth being aware of. So as I said, the traditional volatility control mechanism that we launched, and I was in Europe, based in Europe for much of my career, and that was launched probably in 1995 was the first time they were launched. They've been around for a couple of years. And what they would do at that time, they would look back 40 or 20 days to measure volatility. However, with new technology and better systems that can look at and read a lot more data, we're actually seeing a new breed of vol control indices. And these indices are called intraday volatility control. And what they do is they will measure volatility during the trading day. So they might, for example, look every hour or up to 7 times a day, and they'll measure volatility. So you can think about that as like an enhanced ABS break, almost, much more reactive. Now, at the Index Standard, what we like to do is to sort of really see how are these indices doing, are they adding value? So we went back and looked at some intraday risk control indices over summer of 24. You guys may remember in summer of 24, from July to September, actually a bit of a rocky time for the S&P. The S&P and some major indices fell over 10%. So what we wanted to do, we wanted to compare a risk control index that had a traditional 20 or 40 days, and then we compared it to the intraday that measured intraday over that period. And I'm going to show you the results. So what we did was we looked at the intraday index, and if it was an S&P, we found the standard S&P risk control version, and we matched up the target volatility. So you're looking like for like. And these are the results. So the intraday risk control index is in bold, and then the standard vol control is in the dotted lines. And on these two examples, this is US large cap equities, you can see that the intraday actually did better. It fell less because it's much more reactive. It's like having those ABS breaks. So in both cases, you get lower drawdowns. So that's actually better for the clients. They have a better chance of getting credits. And then secondly, we looked at NASDAQ. We looked at some intraday risk control indices, and again, the standard risk control. And in both cases, the bold ones, which are the intraday examples, they did better. So by the way, the other key point is this is not back tested. This is live. I'm not that interested in back testing. You know, sometimes the back tests are a little bit too rosy. So I like to look at live performance. And what we see is that the risk control feature, intraday one, is doing pretty nicely. So I've kind of gone through how a risk control index works, kind of given you some of the secret sauce behind it. I haven't used any math, but how do you want to describe it to your clients? Well, in the same way that I have an iPhone, I don't really know how the iPhone works. So I don't think you need to go explain a lot of it in depth to your clients. But what you can say is that the risk control mechanism, it's designed to smooth and cushion, and it acts like a shock absorber. I think that's the simple analogy that we like. It's just like a shock absorber. And then you can say that the intraday risk control, that is almost like a shock absorber with, special shocks to really give you that reactive performance. And I kind of showed you, but I want to reiterate the point. The risk control indices do better when markets draw down. So we can see in 2020, S&P fell about 33%. However, the average risk control indices, all the ones that, again, that was live performance, they fell about 11%. So they've done what they're supposed to do when we look at the live performance. So I wanted to maybe make a quick point here. We've seen some of the risk control indices haven't done so well, and it's really been the multi-asset ones. And I want to sort of disentangle that. The risk control feature has actually performed as expected. But within the multi-asset indices, there's been a couple of things that have been happening. Some of the multi-asset risk indices haven't performed because equities and bonds have been going down at the same time. Normally, they're very diverse. Equities and bonds will move in opposite directions. And for up until 2022, for 75 years, they've moved in opposite directions if you look at the calendar years. However, in 2022, they both went down. So it was really the multi-asset indices, because of this correlation, both going down at the same time, that hurt the performance. It really wasn't the risk control feature. That actually has remained robust. So, I want to kind of address a couple myths now that we see in the market. And people say that these indices are not robust. Well, let me kind of give you some inside baseball here. As I talked a little bit earlier, everything is rules-based. And these techniques are what institutional investors have been using for the last couple decades. So they are really democratizing access for our clients. And you've got a lot of banks and a lot of asset managers, and obviously the indexing houses are involved. They are hiring PhDs, they're spending a lot of money on systems, and they're actually building very robust processes to launch these indices. So for example, at one bank, when we were speaking to them, the chief risk officer has to sign off on that index, and he's liable if anything goes wrong. Another bank has a top 4 audit firm that has to review and check all the calculations. And I would say most banks have 3 or 4 committees that they would have to approve one of these indices before it even kind of gets put into an FIA. So there's a lot of stringent processes and controls that the banks and the risk and the asset managers have around these indices. So I want to kind of talk another question. And again, if you remember one thing from this presentation, again, this is my second thing that I think that what I'm going to talk about now is really worth remembering. So I want to ask you a question. I want you to imagine that you're a trader and you're trading the S&P. And let's take you back to COVID. So imagine you're on the desk and you're asked to price an option on the S&P. Now remember what's happening. S&P has dropped 33%. Volatility has gone wild. You're worried about your life. You're worried about your family. You're worried about where you're going to get food and basic utilities, right? That's what you're thinking. Now, if you get asked to price an option on the S&P, are you going to make that cheap or expensive? Well, the key thing that makes you determine that price is volatility. Now, I'm showing you the 1-year rolling volatility of the S&P. You can see in 2007-8, it spikes, and then again in 2020. That is COVID. So if you're pricing an option, the price of the S&P is wildly expensive. And you can see volatility goes up and down, making the S&P very expensive at times, and sometimes it's cheap. But the banks know that volatility can be uncontrolled, it can go wild, so they always add a premium on the S&P. The S&P is always expensive because they know it can go parabolic if there's a big event. And there's a lot of uncertainty. Today is Liberation Day at 4 p.m., so there's uncertainty in the market, so we just don't know what's going to happen. Now what I want to do is show you the volatility of a risk control index. And that's the one on screen in light blue. So wow, look at that. That is very stable and very controlled. And it's very consistent. It's always around the same level. So that's what the volatility control feature does. In addition, for the end client delivering smooth and cushioned performance, for the hedger, it controls the volatility and it makes the option price much more consistent and much better better value for money. And Mitch referenced that in his opening lines. This is the proof. This is why risk control indices have got so popular. This is why the carriers want to use them. This is the graph that kind of explains it all, because that volatility is so controlled, number one. And number two, gives you much better value for money. So that is why they're being used in the industry, and they can enable much more consistent renewal rates, much more consistent par rates. That's why you'll never see the par rate on a risk control index move around a lot. It's much more consistent. Okay, I want to talk a little bit about diversification now. It's a key thing. And, sometimes I feel like I've been a bit of a lone voice talking about diversification in the industry. I've been talking about this for the last 3 years, that it's important. And, in 2022, it was very useful to be diversified. And then again, I think year to date, we've seen what's happened. We've seen a sort of real change up of major indices. We've seen the S&P struggle in negative territory, and we've seen international equities do incredibly well. So you really do want to be diversified. So what is diversification? The key thing is it's spreading out your investments and don't put all your eggs in one basket. And critically, you want to find assets that move in opposite directions. Normally, stocks and bonds will move in opposite directions. So that's why they've been paired together for decades, because they provide this diversification, because they typically move in opposite directions. And the other thing is kind of the S&P doesn't always go up in a straight line. We've had recency bias. We've had 2 fantastic years from the S&P, and then even the preceding 10 years, it was pretty good. And what I'm showing you on screen is the 10-year rolling annualized S&P 500 returns for about 124 years. Now, what you can see is markets go up and markets go down. There's no straight line. So it's very hard to time markets. So I really do think you want to be diversified and blend in something else with your favorite US benchmark. So let me give you an example. Let's say on the left, I take 2 correlated indices with the purple header. I'm choosing 2 indices that both have returns in year 1 and 3. And then on the right-hand side, I'm looking at 2 diverse indices. The index in the dark blue returns has positive returns in years 1 and 3, and then the other one has years 1 and 2. If I combine these in a portfolio, visually you can see that being diverse is much more positive for your portfolio. You get that consistent credits. That's exactly what you want to be thinking about. How do you give those consistent credits to clients? And you want to be compounding. Compounding is the magic of finance. So if you can avoid a zero, you can actually grow your money on a larger nominal sum. That's the key thing. So you want to be diverse to give your clients a return, to allow compounding to happen. And you want to find an FIA that's got a variety of returns in different environments. And, we took a look at the Athene custom risk control indices, and you can see that they got indices that perform in different environments, giving you different kind of return streams. So you want to look for something that's got a large amount of indices that you can build in that diversification for your clients. And then if you combine indices, you can actually sort of get onto something what's called the efficient frontier. So let me give you an example. Let's just say I take the S&P, which is the dark blue line on the left. That's where I'm going to get my sort of risk and return. But if I actually choose a combination of the S&P, and then in gray, that's the S&P fast convergent, the BNP multi-asset index, a USB index, and then a multi-asset index from HSBC called the AI indices. If you take a portfolio of those, you can actually get higher returns for a lower amount of risk. Anywhere along the top of this line is called the efficient frontier. So by blending in other indices, you can actually typically get onto the efficient frontier and actually provide higher returns with a lower risk for your clients. And, year to date, that's certainly something you would want to have thought about. So we're pushing up against time, but we're now going to come to the last section, where I'm going to talk to you a little bit about 122-year analysis that we have done. So what we wanted to do here was we wanted to go back 122 years and see how does the risk control feature work? And secondly, we want to see how does the FIA work? Because no one's done this deep long-term research. And as I mentioned at the top of my presentation, FIAs were developed in Europe in the mid-90s, so they're relatively new. So what we did was the following. At the Index Standard, we went back and we created a US equity large cap index. Think about that as similar to the S&P 500. And we cobbled that going back to 1900. The S&P, the data goes back. They have some data going back. It actually began in the mid-50s. And then they have data going back to the mid-20s. And then we used Professor Shiller has recreated the S&P going back to the 1870. So we used his data to create an index going back about 100, starting at 1900. And then secondly, we did the same for a multi-asset index. We started off with equities and bonds in 1900. It was primarily equity bonds. And then in the 50s, we were able to add gold. And then in the 70s, we were able to add some international international equities to that. So we created a multi-asset index. Now, then secondly, we now have these 2 time series going back to 1900. What we did was we put a risk control mechanism over them. And again, we had to do this old style where we looked at the sort of 1 month or 2 month volatility because of lack of data. But we were able to do that. And then once we created the risk control index going back to 1900, we wanted to see, how does the risk control feature work? Does it actually add any value? And here is the result. So what you can see is on the left-hand side is the equities. So you can see in dark blue, that's the US equity, the risk-adjusted returns. That's like the Sharpe ratio, where we took the return divided by the risk. And you can see in dark blue, US large cap equity, the risk control index gives you about 0.89 versus your standard kind of S&P, it's about 0.58. So that's more than a 50% improvement in returns. Let me just repeat that because that's pretty astounding. You're getting more than a 50% return by sticking to the risk control index. Then secondly, we looked at multi-asset. You can see in orange, the multi-asset index, again, you're getting about a 30% return versus just being invested in your base multi-asset index. Now, some of you might be saying, Laurence, I know that these indices just actually outperformed when there was major crises. So they probably just outperformed in 1920 when we had the 1930s when we had the Great Depression. They probably did better in maybe the dot-com bubble and maybe in the Great Financial Crisis. Otherwise, it's just actually better to be in the base index. So we thought about that. And then we went and had a look decade by decade. So I'm just going to bring that up now. So here what we did was we looked at the risk-adjusted return for the US equity index compared to the risk control version. And we wanted to see which one outperforms. And you can see in the middle of the screen, for the equities, the equity risk control index outperformed 10 out of 12 decades. That's pretty solid. So when did it not outperform? Well, actually in 2 bull markets. So you may remember the roaring 20s. That was just preceding the Great Financial Crisis. The Great Depression, we had this big boom. There's a lot of leverage in the market, and then the market came down in the 1930s. But in the 1920s, it made sense to be in pure equity. And then again in the 1960s. So the 1960s was the beginning of the era of the Nifty 50. It was kind of end of the World War II boom. And again, the pure equity index outperformed. But in the other 10 decades, it really made sense to be in a risk control index. And then likewise for the multi-asset, it outperformed 8 out of 10 times. So again, very solid performance. And it shows the number one, that actually the risk control feature works. And it also shows that being actually invested in multi-asset indices also makes sense as well. So that's the kind of average returns over time. But we also wanted to look at the drawdowns, because that's really what hurts you investing, the drawdowns that kills you. So here we show you the drawdowns. The light blue is the base equity index, and the dark blue is the risk control, and then the red is the multi-asset, and then the orange is the risk control index. I'm just going to highlight those here. So you can see in the worst drawdown of the S&P, which was almost 80% on the Great Depression, S&P went, as I said, down 80%. The risk control index was down around 30%. Likewise for the multi-asset index in the Great Depression went down about 60, and then the risk control version was down about sort of, let's call it 21, 22%. So they've done what they're supposed to do. They help you in those drawdowns. Now, the other key thing is you want to think about markets going forward. At the index standard, we focus on forecasts, and look at these numbers, right? Some of you might be thinking, we're not going to have these kind of great financial depressions like the 1930s or 2007 again. But anyone who was born after 1970 on this call, during your lifetime, you've lived 6 out of these 10 worst drawdowns of the S&P, right? So that's a bit of a sobering thought, right? This is happening in our lifetimes if you're born after 1970, right? Number 2, number 3, number 4, number 6, number 7, number 8 are all happen in someone who was born after 1970. So markets are volatile. I think we've been reminded that of this year, and certainly the risk control feature is a valuable mechanism. Now, the other thing we realized was we've actually got some really fantastic data going back to 1900. So wouldn't it be cool if we could recreate an FIA from 1900? So we actually wanted to do that, and we did. So what did we do? We did the following. We wanted to recreate an FIA payoff and compare that to the US Ag. So what we did was we took, we did the following. We looked at the BBB yield, like investment grade. We subtracted a 2% operating cost for the carrier, and that allowed us to get a budget. Then we went back to our risk control index, and we were able to price an option. Now, because we knew the volatility was controlled, we knew the volatility, so we were actually able to price an option. So once we have the option and the budget, we could then create a payoff. We could sort of say, if every week I invested in an FIA for 1 year, what was my payoff? Because we had the budget, we knew the par rate, and we knew the payoff of the index. And then we cobbled that together. It took us actually about almost a month to recreate, but we were able to create an FIA index, and we were able to compare it to bonds. So let me show you. Now, this is the FIA in black. You can see that it outperforms the US Ag that we created by 4 times. That's amazing, right? Wow. So the FIA, with the ability to cap your losses, always protects your premium, actually does very well when you go and price it over 100 years. Now, we also said to ourselves, let's go and have a look at the last decade, because that's actually been an interesting time where we saw bonds being a little bit rocky. And if I just focus in on the last decade, what you can see is that if I started off with $100 in my FIA, I would end up with over 200. If I just put it into bonds, I'd be stuck at about 120. Now, I want to kind of draw your attention to, I think it's an important period. This is 2020. May you remember that period? It's kind of where I'm circling with my cursor. The S&P was down about 19% in 2022. Bonds were down about 13%, but you can see the FIA was flat. So it protected your capital, and then once market recovers, it starts to give you those incremental returns. So again, this is a really unique graph. And in fact, someone, when I was presenting this at a previous event, said to me, this is the graph I've been waiting for my whole career to talk about FIAs. So that's how valuable it is. This is done by an independent organization. The index standard is independent. We're not owned by any insurance company, any bank, or any indexer. We're owned by myself, my colleagues, and some individuals. We went back and looked at this independently, and we've shown that actually an annuity is a good thing in a portfolio. So that comes up to the end of the presentation. I'd like to sort of give you a quick summary. And I know these indices can seem to be complex, but hopefully we've given you some straightforward ways to communicate the key concepts, right? You can just say that these indices toggle between cash and the risky asset, might be an equity asset. You can simply describe them as like shock absorbers. They're robust. A lot of the banks are putting tremendous amount of money. They have got committees to approve them. They're built for purpose, right? They're democratizing finance. They're bringing these concepts that have been used by institutional investors. They're bringing them to our clients. And then the final thing is, be diversified. I know it's been S&P's done so well, but I think we've got a little reminder beginning of this year why it makes sense to be diversified. And then the final observation is that if you liked any of this presentation, Mitch and his team have some brochures they can very happily share with you, can use them with your clients. So with that, I wanted to just pause and hand it back to our friends at DMI and see if there are any questions.
Thanks so much, Mitch. Maureen, I see a couple questions. One thing I do want to mention is that we do have a white paper, one of them that Laurence referred to, around risk or volatility control will help you to remind you of what the detail of this topic and help you with clients moving forward. But Tyrell also has some additional documents that he can share as well. So bear that in mind. And his contact information, again, is in that QR code. But Maureen, I think we have at least a couple questions here in the Q&A.
Yes, we do. We do. We've got some really good ones, actually. I've been a little impressed here. So, Laurence, if I could just ask you quickly, if you were to project forward, given what you've seen, throughout the past 122 years, and specifically the last slide that you showed, how do you think the FIA space and risk control index usage might evolve in the next 5 to 10 years?
That's a great question. So what I would say is I think you're going to see more innovative indices. These indices are really at the forefront of innovation. The carriers like to use them because they can show innovation. And what I would say is, with better technology and AI, I think you're going to see better and better techniques. So we've already seen, we used to look at 20 or 40 days, we can now look intraday. You'll probably see that's going to come a little, even maybe you might even get sort of by half an hour increments. It gives you an index that cuts the drawdowns even more, makes that pricing much more optimal. So I think we're going to see more complexity. In actual fact, my firm, we're going to start reviewing, just check the performance of some of these artificial intelligence indices. I was just in Europe last month, and I was meeting with an asset manager, a guy who runs an asset manager, and he was telling me he's actually starting to kind of use AI to kind of supplement some of the portfolio managers. So I would expect further use of artificial intelligence, breaking up data. I think it's actually an exciting time, but I would expect the innovation to continue. It's not going to die.
Great. Thank you. From a client education standpoint, I know you touched on this a little bit during your presentation, but how would you suggest an advisor explain the concept of risk-adjusted returns in simple terms, especially compared to focusing on performance?
You know what? That is an awesome question. And I actually was not expecting that question, but I have one more slide that kind of talks a little bit about that. So maybe I'll just jump into that. So we often get that question, and that's why I have this slide. And so, I'll give you an example. And I've had this question. I'm at an event or somewhere, and the S&P's up 10%, and then a multi-asset index is up 5%. And then the advisor will say to me, oh, the multi-asset index, it didn't perform well. It's underperforming. And I'm saying, first key point to your question, Maureen, is you've got to compare apples to apples. So the way I would think about the S&P is like a Mustang. It is super powerful, can go super fast, but when it crashes, it's not pretty. Whereas I would think about a risk control index as like a mini SUV. Kind of can't go so fast, but it can handle the bumps nicely. So you want to compare the engine size. So what I would say is the S&P, its engine size, I'll look at the volatility. It might be, let's say it's 20 vol, and in a mini SUV, the engine size is 5. So it's smaller. So what you really want to do is you want to compare apples to apples. So you want to look at the return divided by the volatility, and let's do it. For my example, so S&P, the return is 10 divided by 20, and then on the multi-asset index, 5 divided by 5. And the answer is the S&P index, is 10 divided by 20 gives me a half, and 5 divided by 5 is 1. So in this example, the multi-asset index outperformed on a risk-adjusted basis, right? And then let's look at that on a par rate. If I look at that in the par rate, another way to look at it is the par rate. On the S&P, because that option price is expensive, as I explained in the graph, you're only getting a 50% par. So I got my 10% return times 50% par, I got a 5% credit. The multi-asset index average par rate's probably 2 and 5% on a 5% index, 5% return times 2, I got a 10% credit. So it actually outperformed when you compare them, when you do the apples to apples comparison. You can either look at the par rates or compare dividing by the volatility. That is what you need to think about. So great question, Maureen.
Great. Thank you so much for that. I have one more I have a bunch more questions. Sorry, they just keep popping in.
Okay.
First, Mitch, let me ask you this because I think this might be more your genre. Does Athene have tools that will show efficient frontiers when blending custom proposals?
Yeah, what we have done in the past is we've tried to put together a diversified portfolio of index selections within our product portfolio. And we did all the efficient frontier research on those particular indices. Matter of fact, we have a brochure if you want it. Email me at manderson@athene.com. I'll be happy to send you. But we took a look at a Callan chart, if you know what a Callan chart is. And we went back about 15 years on each of these indices to see how did it perform in different environments over the last 15 years. And when you look at that, you'll see some indices will win and then they may lose in a particular year. But when they lose, they never lose more than what? 0, because 0 is your hero in an index. We took that, put that into a blender and said, how do we help advisors and clients make educated decisions on allocating in this type of a product? And what we did is by using that efficient frontier research is we came up with what we call the diversified target blend, a blend of our indices to make sure that you are allocated to the right index over time and not trying to time the index. And with that diversified target blend in one of our products, we actually have an automatic rebalancing for you and for your client to make it easy. So every year you automatically redistribute any gain in that contract will be redistributed into other indices that may not have performed. But we're really big on diversification, and Laurence had touched on that earlier in his presentation. We feel that by diversifying with the right indices, and you have diversified index selections, if you do the right allocation, your long-term performance is going to be much smoother and better performance over time.
Great. Thank you, Mitch. You actually answered 2 questions with that. So
really?
that was fabulous. And I am a huge Efficient Frontier and Callan chart fan. So I would love to see that. So you'll be getting an email from me to see those pieces.
Sure.
And then let's see. I have seen very poor performances from many of these types of indexes, PIMCO, JP Morgan, Franklin, used in annuities, which isn't really a question. That's more of a statement.
Yeah.
And how does Athene determine what indexes to use?
And another terrific question. And, if you go back to 2017, Athene is the only carrier that has had anywhere from 2 to 5 of our indexes every year in the top 10. So that statement, if you think about that statement that says, wow, they've had indices that have performed every year since 2017. It always hasn't been the same index. And that's, again, another reason why you want to diversify. But when we look at indices and we're thinking about meeting with an investment partner to see, is this index going to come into our portfolio? How does this react compared to the other indices that we have? Do we have an index that's not performing the way we anticipated it's performing? We take typically about 18 months to 2 years to vet that index to see if that index will make it on our platform. We want to make sure that we're complementing the portfolio. I mean, anybody can have 15 index allocations. We don't want that. As it is, we have 7 on our Performance Elite product and on our accumulator product. That's a lot of indices that is out there, and you can buy it with and without a strategy charge, which makes it even more complicated. So we're trying to simplify it, but yet make sure that we have a diversified view of indices for your client to allocate to.
And Maureen, can I just jump in with a quick comment on the performance? I sort of did address it in my presentation, but I think in 22, 23, a lot of the multi-asset indices fell because they're designed on the concept of diversification. Let's say the multi-asset index might have had stocks and bonds, and they normally move in opposite directions. However, in 2022, they typically fell, and that's what drove some of this poor performance in 22, definitely in 23. And now, however, what we've seen is a total rebound year to date, where we've seen all the multi-asset indices have done incredibly well because international's done well, bonds have done well, and the S&P's done poorly. But the risk control indices, on looking on an average credit basis, you're probably getting a credit of, I want to say, 2 or 3 year to date, and the S&P you're at 0. So it's they've turned around the year to date.
And some of that also may be, keep in mind that some people may have invested in three-year point-to-point indices that did not perform very well. And that's a hard pill to swallow for a client when you lock up your money for 3 years and you get a great high participation rate, but the index doesn't perform. It kind of, for an advisor to have that meeting with the client, I'm sure it's a very uncomfortable meeting. We try and stick to 1 and 2 year index point-to-point options for that reason, because any index could be down, over a period of time.
And that's a great point. Some of our research indicates it's good to be diversified across index type, but across, time in terms of 1, 2, 3 year crediting strategies. So be diversified across both those aspects.
Hey, Tyrell, you know what? I know you probably have a lot of conversations like this from day to day regarding volatility control and that kind of thing. Do you have any thoughts or maybe even questions for Laurence, or why do you think this is important that we're discussing this today?
Yeah, so I've seen this as I talk with reps, and also I tell all of my reps I have my own clients as well, and I've seen this within my own clients' portfolios as well. The diversification, that's, I think, a topic that can't be discussed enough. And I think a lot of times why I think it's important to discuss and it can't be discussed enough is that I think most advisors that I've talked with, when I do start talking about diversification, the pushback that I've gotten is, well, Tyrell, I can't lose anything. The zero is your hero, which is true. But they say, I can't lose anything, so why would I diversify? I can just go with one index. But because we have the zero is your hero, the diversification isn't to minimize downturn, it's to maximize the upside and to maximize the opportunity. At Laurence's point, it's, if I have a year that's 0, I've lost my compounding on that, right? Lost the opportunity for a compound, which is exactly. The point. Compounding, interest is enormous. And so the diversification comes into play for maximizing returns, because we in an FIA chassis, because we have the downside protection already from loss, we want to maximize our opportunity for return year over year so that we can then also maximize on the compounding of that interest. And so I think that was a great point that Laurence brought up that I maybe have missed on some conversations with reps, that's to point out also, when you have those 0 years where we're not maximizing the opportunity for return, you're missing out on the compounding in that year as well. So I thought that was a great point.
Well, thanks, Tyrell. No, I appreciate it. And actually, I was going to share your contact information here in case anybody has questions. So obviously, we've got great support from Mitch Anderson and the likes of Laurence Black, and then our own Tyrell Jensen here. So he's some of the connective. Tyrell is some of the connective tissue between Mitch and Laurence and others. So feel free to reach out to Tyrell. And I think also just be aware we are going to share this presentation today. And then again, we will also share the volatility control white paper. I think is going to be really helpful for you. And then Tyrell has a bunch of other stuff from Athene as well that he can share. So I don't know if anybody else has any other thoughts. Maureen, I think we're done with questions. Is that correct? We got all the questions answered?
Yeah, we're all set with that. Thank you very much.
Okay. Did anybody have any last thoughts? Mitch, Laurence, Tyrell?
Yeah, this was fun. Great that so many people stayed on till the end, and I thought it was a lovely setup. So thank you very much for the opportunity.
Yeah. Well, thank you, Laurence. It's really an honor to have you on, and hopefully we can do it again in the future. So thanks so much. Tyrell, Mitch, really appreciate you being here. Maureen, thank you too. And everybody, appreciate you joining.